welcome to the Deep Dive. Today we're digging into wisdom of Benjamin Graham. His ideas, honestly, they still shape so much of how we think about investing, even now.
Decades later, yeah. It's quite remarkable.
Absolutely. But let's kick things off with a story, because it really shows why his thinking is still so relevant. Picture this. April 1919. Benjamin Graham, he's already moved up fast, from clerk to running his own investment partnership.
Right.
And he makes this incredible 250% return on the very first day of trading for a new stock, Save Tire.
Wow, 250% a day sounds amazing, like hitting the jackpot.
Exactly. But that jackpot vanished fast. By October, just a few months later, Save Tire. Total fraud. Stock becomes completely worthless.
Ouch. Yeah, that's a harsh lesson. And you can see how an experience like that so early on would just fundamentally shape his entire philosophy. It's a perfect example of the kind of speculative bubble he warned against his whole life.
Totally. That Save Tire experience, it really forged his core ideas, didn't it? So it makes sense that his whole philosophy hinges on this really crucial distinction. And that's our mission today in this deep dive, to pull out the most important nuggets of wisdom from his classic book, The Intelligent Investor.
Yeah, it's foundational.
It really is. And it's not just some dusty old book. It's been updated. People have added commentary, which actually shows how enduring Graham's principles are. We want to make these sometimes complex ideas clear, practical, and really relevant for you listening today without it feeling, overwhelming.
And what's great is Graham wasn't just some academic theorist, right? He lived this stuff. Started as a clerk, became an analyst, a partner, ran his own firm. He got really good at digging deep into companies, like really microscopic research. There's that famous story from 1925 Northern Pipeline Coast. Stock's trading at $65. Graham digs in and finds out, wait a second, this company's holding at least $80 per share just in high-quality bonds.
$80 in bonds when the stock is $65.
Exactly. So he buys the stock, puts pressure on management, and boom. 3 years later, he gets $110 per share. The key wasn't just spotting something cheap. It was the rigorous, fundamental analysis he used to uncover that value. That's the core.
So those early experiences, the win with Northern Pipeline, the loss with Save Tire, they pushed him to define what real investing actually is.
Yeah.
And he gave us this really clear definition. An investment operation is, quote, one which, upon thorough analysis, promises safety of principal and an adequate return.
Seems simple on the surface, doesn't it?
Yeah, deceptively so. But there's a lot packed in there. Can you kind of unpack those elements for us?
Absolutely. 3 pillars, and they're all equally vital. First, thorough analysis. You got to understand the actual business you own deeply, not just the ticker symbol flashing on a screen.
Okay, analysis first. Makes sense.
Second, deliberate protection against serious losses. You're actively trying to build in a safety net, not just crossing your fingers. It's about loss prevention.
Right.
And third, aiming for an adequate return. Not necessarily extraordinary, shoot the lights out performance, just adequate, solid, reasonable.
Adequate. That word is interesting. It sounds almost modest.
It is, in a way. But it's crucial. Investing, for Graham, isn't just about picking winners. It's a discipline. It's about protecting yourself, having a rigorous process to avoid those big, catastrophic mistakes. It's not about chasing crazy gains.
And this leads right into that big distinction he makes between what he calls investing and just stock trading. How did he draw that line? Why was it so important?
Well, he explicitly ruled out trading from the definition of investment. Why? Because it typically lacks those key ingredients, safety of principal, and a satisfactory, adequate return based on analysis.
So if you're just chasing price movements.
Yeah, if your main focus isn't that deep analysis for preserving your capital and getting a reasonable return, but it's more about quick profits from market swings or, the latest hot trend, then in Graham's view, that's speculation. It's basically gambling, and it puts you in a totally different risk category.
Got it. And he also knew that not everyone invests the same way. He talked about 2 main types of intelligent investors: the defensive or passive, and the enterprising or active.
Right. And importantly, he stressed that both can be equally intelligent. Both paths can lead to success. The key is you need to figure out which approach fits your personality, your time commitment, your temperament, and then stick with it.
So it's as much about knowing yourself as knowing the market.
Precisely. Because, as we'll see, a lot of financial risk isn't just out there in the market. It's inside us, our own emotions, our reactions.
Yeah.
And understanding that internal risk is huge, which leads us to maybe his most brilliant tool for dealing with the external chaos, Mr. Market.
Ah, yes, Mr. Market. Such a fantastic metaphor. Okay, so imagine you have a business partner, right, Mr. Market?
Mm-hmm.
Every single day, Without fail, he
Oh.
shows up. He offers to buy your share of the business or maybe sell you his share, and he names a price.
Every day, a new price.
Every day. Sometimes the price seems, well, reasonable. It reflects what's actually happening with the business. But a lot of the time, Mr. Market is completely manic depressive.
Yeah, that's a good way to put it.
One day he's euphoric, totally over the top, offering crazy high prices. The next day, he's panicked, terrified, practically willing to give his shares away for pennies.
And the lesson Graham draws from this is just profound. Mr. Market isn't just some quirky character. He's basically your daily emotional stress test.
Right.
The intelligent investor learns to view Mr. Market's wild mood swings not as signals to act impulsively, but as potential opportunities. When he's terrified and prices are low, maybe you think about buying. When he's ecstatic and prices are sky high, maybe you consider selling. You decide. You use his irrationality. You don't let it control you.
It seems so logical when you explain it like that. But, why do so many people, even professionals, get sucked into Mr. Market's moods? That constant ticker tape, the ease of trading now.
It's incredibly tempting, isn't it? That constant feedback loop of prices makes investors feel like they have to react. And yeah, even professional money managers often fall into that trap. They start mimicking Mr. Market, buying high when everyone's excited, selling low when panic sets in.
Why do they do that? Managing huge sums, maybe?
That's part of it.
Yeah.
Managing billions often forces them towards the biggest, most popular stocks, which can often be the most overpriced ones precisely because they're popular. It becomes herd behavior.
So Graham's advice.
His wisdom here is basically don't just do something, stand there. Sometimes the smartest move is inaction. He even suggested that the term long-term investor is kind of redundant.
Redundant? How so?
Because in his view, that's the only kind of real investor there is. Someone who's constantly jumping in and out, who can't hold on to stocks for more than a few months. They're almost destined to be a victim of Mr. Market, not a beneficiary.
Okay, so if Mr. Market's daily prices don't define risk, what does? This gets to Graham's really interesting, almost counterintuitive view of risk and safety. For most people, seeing a stock price fall feels like risk.
Absolutely. It feels like you're losing money.
But Graham says, hold on, a drop in market price doesn't automatically mean a real loss, especially if the underlying business itself is still sound. So what did he see as the actual fundamental risk in investing?
The real risk, according to Graham, the thing you truly need to fear is paying too much. Paying an excessive price for a security relative to its actual underlying value, its intrinsic worth. That is the cardinal sin.
Paying too much.
Yes. Think about it.
Yeah.
Let's say you find a great company, you analyze it, and you think, okay, this can grow 10% a year. Fantastic. But you get so excited, maybe Mr. Market is euphoric, and you overpay significantly. Let's say the stock then drops 50% in the first year because reality sets in. Even if it then performs exactly as you hoped, growing 10% every year after that big drop, it could take you something like 16 years just to catch up to a boring old market index fund that was only growing at 5% annually the whole time.
16 years just to break even relative to the market. Wow, that cost of loss idea is incredibly powerful. It really shows the long-term damage of overpaying, even for a good company.
Precisely. It drives home Graham's core insight here. The risk is not in our stocks, but in ourselves.
And ourselves.
Yeah. It's about overestimating our own knowledge, or maybe overestimating our emotional ability to stick with an investment when it inevitably plunges.
Yeah.
That's why that critical thinking, that discipline about your own potential biases and behaviors is absolutely essential for actually managing risk.
Okay, that's a great foundation. Let's get practical now. How do we actually build a portfolio using these Graham principles?
Okay.
Let's start with something everyone faces, inflation.
Right. Inflation's always a factor. Graham saw big inflation spikes back in his day, too, like that 15% jump between 65 and 70. His advice was clear. As an investor, you have to factor in the likelihood of ongoing, or at least recurring, inflation. It erodes your purchasing power.
So how do you protect against it? Stocks, bonds, something else?
Well, he argued that stocks, while definitely not a guarantee, should generally offer better protection against inflation over the long run compared to bonds, whose fixed payments lose value as prices rise.
What about gold? People often talk about gold as an inflation hedge.
Graham was cautious about holding physical gold directly. Storage costs, insurance hassles. His thinking was more along the lines of, if you really want some exposure to precious metals, maybe consider a well-diversified mutual fund that invests in mining companies. But even then, keep it small, like maybe 2% of your portfolio, perhaps 5% if you're older, say over 65.
So diversification and caution, even with hedges.
Exactly. Prudence above all.
Okay, let's talk about the bond part of the portfolio. Graham talked about choosing between taxable bonds and tax-free ones, like municipal bonds. What was the key consideration there?
The absolute key is after-tax return. This is classic Graham practicality. You have to look at what you actually get to keep after the taxman takes his share. A municipal bond might offer a lower interest rate, say 5.3%, compared to a corporate bond at 7.5%. But if you're in a higher tax bracket back in his day, maybe 30% or more, that tax-free 5.3% from the muni bond could actually put more money in your pocket than the taxable 7.5% from the corporate bond. You have to do the math for your specific situation.
That's a really important point. It's not just the headline yield. He also looked at different types of bonds, right? Government bonds, munis.
Yes, he covered the spectrum. U.S. government bonds, certain state and local municipal bonds, always paying attention to quality ratings like AA or AA from Moody's or S&P. He wanted reliability.
What about those slightly more unusual ones, like income bonds or convertibles?
Income bonds, where the interest payment depends on the company actually earning enough money, they often had a bad reputation, a prejudice, as Graham called it, because they were sometimes issued by companies in trouble. But Graham, being Graham, looked past the prejudice to see if the terms themselves offered value.
Always looking at the specifics.
Always. And convertible bonds that can be converted into stock, they've actually become more common and generally less risky since Graham's time. You see more medium-term investment-grade ones now, but they are often lower in the pecking order if the company gets into trouble. So for most people, he'd likely suggest a low-cost convertible bond fund for diversification rather than picking individual ones.
Okay, that makes sense.
Yeah.
So moving to stocks now, specifically for that defensive investor type, the one prioritizing safety and simplicity. What was Graham's core advice there?
Simplicity and safety are paramount. He suggested, as a general rule, maybe keeping no more than 50% of your portfolio in stocks unless you personally have very strong reasons and deep conviction based on your analysis.
50% max is a default.
Yeah, a balanced approach. And a key strategy he championed for the defensive investor is dollar cost averaging.
Right, investing the same amount regularly.
Exactly. Maybe you set up an automatic investment, say $500 a month, maybe split across a few broad low-cost index funds, like one for the total U.S. stock market, one for international stocks, one for U.S. bonds.
Why is that so effective?
Because it takes emotion out of the equation. You invest the same dollar amount whether the market is up or down. You end up buying more shares when prices are low and fewer shares when prices are high. It enforces discipline.
But any caveats?
Well, he did caution about starting a new dollar cost averaging plan when the market seems really, really high, especially if you feel you might lack the emotional stamina to stick with it if the market drops soon after you start. You need to be prepared for potentially seeing losses initially.
Good point. What about IPOs? Initial public offerings. They always get so much hype, seem like lazy money sometimes. What was Graham's take?
Deeply skeptical. He basically said IPO often stands for it's probably overpriced or imaginary profits only. He warned that for every dollar you might make in IPOs, you'd be lucky if you only lost 2.
Oh, okay.
He pointed to historical examples like a bank stock frenzy way back in 1825 or more recently, the dot-com IPO mania of the late 90s. Remember eToys?
Vaguely. Yeah, big flame out.
Huge. IPO'd at $20, shot up to over $76 on day one. But the company's own prospectus basically warned it wasn't profitable and might never be. Sure enough, bankrupt within 2 years. The lesson. That easy money hype surrounding IPOs is usually just that hype. It rarely leads to solid long-term value for the average person buying in.
So avoid the IPO frenzy. What about those seemingly sophisticated strategies you sometimes hear about, like this system turned $10,000 into $8 million? James O'Shaughnessy's work is sometimes cited.
Graham, or at least the commentary in later editions, acknowledged those studies. But the caution was always, be careful. Many of these what works on Wall Street findings, like the so-called January effect, where small stocks supposedly do well early in the year, often look great on paper, but the potential gains can get completely eaten up by real-world trading costs, especially for tiny, illiquid stocks. Those costs can be huge, maybe even 8% round trip.
8%. That wipes out a lot of potential gain right there.
Exactly. So the deeper point for the defensive investor is genuine, reliable long-term results come from patience, discipline, low-cost diversification, not from trying to time the market or chase the latest complex data mine strategy. Like Graham might say, the defensive investor often wins the race by just sitting still patiently.
Okay, so that's the defensive investor. Now, what about the enterprising investor? The one who's willing to put in the extra effort, apply maximum intelligence and skill, hoping for better than average returns. What should they be looking for in stocks?
This investor goes deeper. They still need a minimum level of quality, looking at past performance, financial strength. But crucially, they're also looking for a minimum quantity of value relative to the price paid. They want more earnings, more assets per dollar invested.
This sounds like bargain hunting.
It is, in a sophisticated way. Graham famously talked about searching for 60-cent dollars, trying to buy businesses for substantially less than their estimated intrinsic value, maybe 60% or less.
60 cents on the dollar. How do you find those?
One specific area he highlighted was looking for sub-working capital stocks. These are situations, quite rare, mind you, where the company's common stock is selling for less than its net working capital alone.
Wait, less than working capital. What's that mean?
Net working capital is basically current assets minus all liabilities, short-term and long-term. So if the stock price is below that, you're essentially getting the cash, receivables, and inventory for less than their value and paying nothing for the buildings, equipment, brand name, or future prospects.
Wow, that sounds like a true bargain.
They are, when you can find them and verify the numbers. It requires serious digging, but historically, finding those sorts of situations has been very profitable for diligent, enterprising investors.
What about growth stocks? The high flyers everyone gets excited about, especially in bull markets. Should the enterprising investor chase those?
Graham was very cautious, even for the enterprising investor, particularly when growth stocks reach really high prices. He lived long enough to see many glamorous growth stocks eventually crash and burn.
Any examples?
Oh, yeah. The commentary points to giants like Microsoft dropping nearly 56% between 2000 and 2002, or Cisco. It fell 76% in that same period after having gone up something like 50 times in the previous 6 years.
Oof, 76%.
Yeah. His warning was timeless. The hotter they are, the harder they fall. Even great companies, what he called goodwill giants with excellent records and strong growth expectations, can be dangerous if you overpay. He always preferred companies where the tangible asset value provided a safety net, ideally covering at least 2/3 of the market price.
So even for the active investor, that margin of safety based on assets is still important.
Very important. And he explicitly warned against buying second-quality issues. Companies that aren't leaders, maybe have weaker balance sheets, unless they are undeniably cheap, true bargains based on thorough analysis. Why? Because those tend to get swept up and overvalued in bull market euphoria, and then they fall much harder and stay down longer when the tide turns.
Okay, that makes sense. Now, Graham didn't just talk about picking stocks. He also had some strong opinions about company management and the role of financial advisors. He wanted shareholders to be more active.
Yeah, more intelligent and energetic, as he put it. He thought shareholders shouldn't just be passive bystanders. If a company's results are consistently poor, maybe lagging its competitors, or the stock price is stuck in the mud for years, you, as an owner, should demand clear explanations from management.
So, hold their feet to the fire.
Exactly. He was implicitly pushing for what we'd now call shareholder activism. Things like voting against directors who aren't performing, actually showing up to annual meetings, using forums like online message boards today to connect with other shareholders, and pushing for more independent directors who could provide unbiased reports directly to the shareholders, not just filtered through management. It's about exercising your rights as an owner.
Interesting. What about how companies use their cash? Dividends, buybacks? Yeah, there's always debate about that.
Right. There's the famous academic argument from Miller and Modigliani that theoretically dividend policy is irrelevant to a company's value.
But Graham didn't quite buy that in practice.
He was definitely concerned about companies just hoarding huge piles of cash. He saw companies like Oracle, Cisco, Microsoft sitting on billions and billions in the early 2000s, with that cash earning very little return for the actual owners, the stockholders.
Why do companies do that?
Well, sometimes there aren't great reinvestment opportunities, but Graham also suspected that CEOs often preferred using cash for stock buybacks, even if the stock price was already high.
Why buy back expensive stock?
One reason, perhaps cynical but possibly true, is that buybacks tend to make executive stock options more valuable. Reducing the number of shares can help boost the price per share, and it also increases volatility, which mathematically increases the value of options. Graham felt surplus cash should either be reinvested in truly profitable projects or returned to shareholders via dividends so they could decide what to do with it.
Okay, let's switch gears to getting financial advice. Grant had some warnings there too, right?
Yeah.
Especially for you, the listener.
Absolutely. His main point was, don't just blindly follow recommendations from financial service firms. Think of them as suppliers of information, maybe suggestions, but not as the final decision makers. The ultimate responsibility is yours.
So do your own homework on the advice itself.
Yes, and especially on the advisor. If you hire someone, you need to investigate their trustworthiness, understand exactly how they're paid or their conflicts of interest, get referrals from people you genuinely trust.
And he had that list of slick phrases advisors might use that should make you wary.
Yeah, those are great red flags. Things like, trust me, or pushing commodities trading or overly complex active asset allocation strategies, or claiming, we can cap your downside, which is often harder and more expensive than it sounds, or the classic, no one else knows how to do this.
Alarm bells should ring.
Definitely. These phrases often signal high risk, hidden fees, a lack of transparency, or just unrealistic promises. Buyer beware.
He was also pretty critical of how some financial analysts worked, wasn't he?
He was. Particularly, he observed analysts becoming increasingly reliant on complex mathematical models and forecasts, especially for growth stocks.
What's wrong with using models?
The problem is, for growth stocks, the valuation depends heavily on predicting the distant future earnings, future growth rates. And that's precisely where forecasts are least reliable and most likely to be wildly wrong. The further out you project, the more sensitive the valuation is to tiny changes in assumptions. Graham's whole approach was grounded in present facts, tangible assets, current earning power, things you could actually analyze with some confidence, not just speculate about years down the road.
Rely on the knowable present, not the unknowable future.
That's a good way to sum it up.
And his book uses so many real-world examples, these instructive case histories, to show what happens when things go wrong or right. Let's touch on a few of those cautionary tales.
These are so important because they make the principles concrete. You had WorldCom, massive accounting fraud, overstated earnings, huge bankruptcy. A bond offering they did shortly before collapsing was something Graham would have found appalling based on his safety metrics. Then Quest Communications had to restate its financials. Stock lost 90% of its value. Penn Central Railroad looked stable, long dividend history, but went bankrupt. Why? Because a careful analyst like Graham would have seen years earlier that it wasn't actually earning enough to cover its fixed charges, like debt payments. A huge red flag he always looked for.
What about accounting tricks?
Ling Temco Vought was famous for using big bath accounting, taking huge write-offs all at once to make future earnings look better. Stock went from $111 to $7 in under 3 years. And AAA Enterprises, just pure hype around the franchising concept in the 60s, bankrupt within 2 years. These stories all scream the same warnings. Beware of complex or deceptive accounting, be wary of excessive debt, and don't get swept up in hype.
So those are the disasters.
Yeah.
But he also used pairs of companies to show the wisdom of focusing on the business, not the hype.
Yeah, these contrasts are brilliant. Think Cisco versus Cisco around the dot-com bust.
Okay, Cisco the tech giant, Cisco the food distributor.
Exactly. Cisco, the darling, lost 75% of its value from 2000 to 2002. Meanwhile, boring old Cisco, just reliably delivering food and profits, gained 56% in the same period.
Wow. Boring beat glamorous.
Big time. Another pair, Yahoo versus Yum Brands. In '99, Yahoo was trading at a mind-boggling 164 times its earnings. Pure speculation on future hopes. Yum, which owns Taco Bell and KFC, was trading at a reasonable 15 times earnings based on actual profits.
Guess which one did better long term?
No contest. And one more, CMGI, another dot-com incubator versus CGI Group, a Canadian IT consulting firm. CMGI lost 99.4% from 2000 to 2002. Gone. CGI gained 60% over that time. The pattern is clear. Durable business value versus fleeting market sentiment. Substance over sizzle.
That leads us perfectly to the absolute cornerstone of Graham's entire philosophy. The margin of safety. He called it the central concept of investment, your ultimate protection. What exactly is it?
At its heart, the margin of safety is the difference between the price you pay for a stock and its underlying conservatively estimated intrinsic value. Or, put another way he's sometimes used, it's the cushion provided by the company's earnings power relative to the yield you could get on a safe bond.
So it's a buffer.
Exactly. It's a buffer. It's there specifically to absorb unsatisfactory developments. Because things will go wrong sometimes. Forecasts will be off, industries will change, Management might make mistakes. The margin of safety is what protects you when the unexpected happens. He gave an example from 1965. The typical stock yielded about 9% earnings compared to 4% on bonds. That difference, that 5% extra earnings yield, was the margin of safety.
And why is having this buffer, this margin, so absolutely critical for being an intelligent investor? What does it really give you?
What it gives you is liberation. It means you don't need superhuman insight or perfect foresight to succeed. If you consistently buy securities only when there's a significant gap between price and value, you build in room for error. You can be wrong about some things and still come out okay.
So it protects you from your own mistakes.
Precisely. It's a form of built-in humility and realism. It acknowledges that we will make mistakes, the future is uncertain, the margin of safety is how you manage that reality.
But what's the risk, the cost, if you ignore it? If you just buy hoping for the best?
The danger is huge. If you concentrate your buying when the market is already high and expensive, or if you buy risky, speculative stocks that have no buffer, no margin of safety built into the price, you're exposed. You have no cushion when things go wrong.
Which connects to that Pascal's wager idea you mentioned earlier.
Exactly. It's like an investment version of Pascal's wager. You can't know for sure if a stock will go up, just like Pascal couldn't know if God exists, but you can control the consequences if you're wrong. The intelligent investor focuses on limiting the potential damage by demanding a margin of safety. The probability of making some mistakes is close to 100%, so you need to ensure those mistakes aren't fatal.
And people forgot that in the dot-com bubble.
Massively. So many people who called themselves investors poured almost all their money into wildly overpriced tech stocks in 1999. Stocks with no earnings, no assets, absolutely no margin of safety. They were betting everything on being right with no protection if they were wrong. They took the wrong side of that wager.
Wow. Okay, that really brings it all together. That wraps up our deep dive into Benjamin Graham's The Intelligent Investor. We've covered so much ground.
We really have. From that crystal clear definition of investing analysis, safety, adequate return to the genius of Mr. Market, and why you need to ignore his moods.
Yeah, and adapting to inflation, thinking carefully about bonds versus stocks, the different approaches for defensive and enterprising investors.
Holding management accountable, being skeptical but informed about financial advice, and then tying it all together with that absolute bedrock, the margin of safety.
So the goal here was to give you, the listener, a kind of shortcut to being well-informed on these timeless principles. To equip you with practical ideas and maybe some surprising facts to help you navigate the financial world more intelligently. What's the final thought we should leave everyone with?
I think it comes back to that idea we touched on earlier. At the end of the day, the real financial risk you face doesn't ultimately reside in what kinds of stocks or bonds you own.
Okay.
It resides in what kind of investor you are, your temperament, your discipline, your process.